As the Canadian economy continues to adjust to U.S. trade restrictions, we expect the economy to grow modestly and inflation to stay close to our 2% target. However, uncertainty around our forecast is heightened.
All right, so this is the first interest rate announcement of the year. There's some uncertainty.
Very much so. I can't recall the last time I've heard a central bank governor being this uncertain about the start of the year, how things are going to develop. And he was right out there saying the trade talks, the renegotiation of USMCA this summer, that's the wild card.
The Bank of Canada just made their first rate decision of 2026, and if you're confused about what it means for your mortgage, you're not alone. Because the bank didn't cut, they didn't hike, they held. And then Governor Macklem said something that should have gotten a lot more attention. Elevated uncertainty makes it difficult to predict the timing or direction of the next change. That's central bank speak for, we genuinely don't know what's coming next. Today I'm going to break down exactly what this means for your mortgage strategy and why I'm still comfortable making a very clear call. My name is Greg Williamson. I'm a mortgage broker with 34 years in the business, and this channel exists because I believe mortgages should be managed, not guessed. Every week I break down what's actually happening in the economy, what it means for rates, and most importantly, what strategy makes the most sense right now. Hey, there's no wishy-washy advice here. We make real calls. So let's walk through our mortgage market dashboard. These are the signals we track every week to guide our strategy. Signal number one, the Bank of Canada policy rate. It was held at 2.25%. As we talked about, prime rate stays at 4.45%. This puts us right in the middle of what the bank calls their neutral range. Not stimulating, not restricting, just neutral. The key quote from Macklem, we judge the current policy rate as appropriate. Translation, we're not moving unless something forces us to. Signal number two is the Canada 5-year bond yield. It's still holding around 2.9%. This is the number that drives 5-year fixed mortgage rates, and it's been stubbornly elevated despite inflation coming down. Why? Risk premium. More on that in a minute. Signal number three, inflation trend. December inflation came in at 2.4%. That's a slight uptick from 2.2%. But here's the thing. That was mostly base year effects from last year's GST holiday. Core inflation, the stuff the bank actually cares about, it's been cooling from 3% in October down to 2.5% in December. That is our friend here. Signal number four is growth outlook. The bank is projecting 1.1% growth for 2026. It's barely above stall. And that matters because the bank cannot hike into a weak economy without breaking things. Household debt is massive, housing is fragile in Canada, and the consumer is tired. Signal number five is employment and unemployment. Rose to 6.8% in December. Not crisis territory, but the direction is that the labor market is softening. When jobs wobble, rate cuts come back on the table fast. Inflation is cooling, but not at target. Growth is weak, but not collapsing. Employment is softening, but not cratering. The bank is stuck right in the middle. And then there's the trade situation. Governor Macklem was unusually blunt about this. He said, and I'm paraphrasing, just when we think we've thought of everything that could hit us, something new happens. And that's not a coincidence. That's a central banker admitting they're flying blind on one of the biggest variables. The CUSMA review kicks off in July 2026. This is the mandatory review of the Canada-US-Mexico trade agreement. And based on everything we've seen from the Trump administration, this is going to be a high-stakes negotiation. Prime Minister Carney recently admitted there's little evidence Canada will secure a deal without some tariffs. That's not pessimism, that's realism. And here's why it matters for your mortgage. If trade talks go badly, which is what we think is going to happen, if we get any escalation, if there's a growth shock in any event, that's a risk-off event and money flows into bonds. Yields fall, fixed mortgage rates can drop fast. Ironically, the very uncertainty people are worried about is often what creates windows for lower fixed rates. It's counterintuitive, but that's how markets work. Now, let me address something that's been confusing a lot of people. If inflation is cooling and the economy is weak, why aren't fixed rates lower? Here's the answer. Risk premium. Historically, when core inflation is where it is right now, bond yields were about 235 basis points lower than they are today. In plain English, 5-year fixed rates should be about 2.35% lower than they are. So why aren't they? Because bond investors are demanding extra yield as insurance. Insurance against future inflation risk, fiscal credibility concerns, trade policy chaos, central bank uncertainty. That premium can compress quickly if confidence returns, but it hasn't yet. And that's why we're seeing this disconnect where inflation looks okay, but mortgage rates feel sticky. The good news, risk premiums don't last forever. Once that uncertainty clears, and when we get clarity on where we are in the trade agreement, when the fiscal picture stabilizes, that premium compresses. When it does, that's another way that fixed mortgage rates can fall. So here's my call for this week. Clearly and without hedging, for most borrowers, variables with a management strategy will make the most sense. Why? Because the economy can't absorb higher rates. Canada can't sustainably diverge from the US, and the US will be cutting. The pressure over the next 12 to 18 months is toward easier policy, not tighter, more liquidity, more money printing. And when fixed rates do enter our target zone, we can convert. Hey, we're not marrying variable, we're just dating until fixed comes back into our strike zone. Now, our tells for when to convert, when fixed rates drop to our target zone, and we have that in our systems, when bond spreads normalize that compression, if yields break out and stay elevated for an extended period, that's an act of mortgage management. If you lock in a fixed rate today at say 4.25%, and 6 months from now, fixed rates drop to 3.75, what can you do? If you're at a bank or with a broker who isn't actively managing your mortgage, probably nothing. You're stuck with a punitive penalty if you try to break that mortgage. But if you're working with us, we have our $5,000 maximum penalty guarantee. If your mortgage penalty in the future for breaking your mortgage for any reason is greater than $5,000, we cover the difference. If your penalty is less than $5,000, then we split that 50-50. We're so confident in our track record that we cap your penalty exposure. That's what managed mortgages look like, and here's what we're watching for next week. Trade headlines, any escalation or de-escalation on CUSMA, employment data, the next jobs report, and what that will do to bond yields. We're watching for any compression in that risk premium, and we're looking at lender pricing, whether fixed rates start to loosen, and of course, the sell-off in metals this week will filter through the economy. The next Bank of Canada decision is March 18th, so we've got time, but we expect another hold unless something materially changes. If you want your mortgage managed, not guessed, subscribe to this channel, smash that button. And if you want a personalized strategy based on your specific situation, click the link in the description or the pinned comment below to book a call with me, because your mortgage is way too important to leave to chance. See you next week.